Arthur Hayes, former CEO of BitMEX, has just delivered one of the harshest warnings of this cycle about the newly launched Layer 1 blockchain Monad and its token MON. Speaking on Altcoin Daily, Hayes described Monad as another high-FDV, low-float BC coin, referring to a project with a very high fully diluted valuation, a very small circulating supply, and strong backing from venture capital investors. He warned that once the initial excitement fades, the token could lose up to 99% of its value. His exact words were, "It's going to be another bear chain." Monad officially went live on November 24 after raising $225 million in a paradigm-led round last year. Despite a roughly 30% price increase over the past week and an airdrop that generated significant attention, Hayes argues that the underlying tokenomics create a structural trap for retail investors. The core problem lies in the massive gap between Monad's fully diluted valuation and its circulating supply, combined with heavy allocations to venture capitalists and the team at extremely low entry prices. When vesting cliffs end and unlock schedules begin, early investors will be able to sell billions of dollars worth of tokens into a relatively thin public float. History shows that this pattern almost always leads to violent, sustained sell pressure. Hayes emphasized that short-lived pumps in projects with this design rarely reflect genuine adoption. They are typically liquidity events for insiders. Retail participants who buy the top often become the exit liquidity. When asked which Layer 1 chain he believes will actually survive the next several market cycles, Hayes named only 4: Bitcoin, Ethereum, Solana, and Zcash. Every other contender, in his view, lacks the necessary combination of community, liquidity, developer activity, and institutional relevance to endure. Despite this bleak assessment of Monad and similar projects, Hayes remains strongly bullish on the broader cryptocurrency market. He stated, "I think that we are at the end of the beginning of this cycle, and the massive amounts of crazy bull market money printing is ahead of us." He expects renewed global liquidity, particularly from the United States and China, to propel risk assets higher regardless of Bitcoin's halving schedule. In his framework, synchronized credit expansion, not the halving, has always been the primary driver of major bull markets. The takeaway is clear. The macro environment may favor cryptocurrencies as a whole, but individual asset selection has rarely been more important. Projects with balanced distribution and proven staying power should be prioritized. High-FDV, low-float tokens backed primarily by venture capital continue to carry extreme downside risk when unlocked calendars approach. If you found this analysis useful, please consider liking the video and subscribing to the channel for more in-depth coverage of market structure, tokenomics risks, and macro-driven crypto cycles. Thank you for watching, and I'll see you in the next one.